Hello, today we're going to talk about Chapter 25, which is entitled Capital Investment Analysis. And if I had to sum up this chapter, it's basically a capital investment is you taking money, investing in something, whether it's a project, a piece of equipment, or whatever, that will generate you more revenue. And so we're going to analyze how do I know which capital investments I should make. So this is a short and fairly easy chapter, but just pay attention to some of the components we're going to talk about. So again, capital investment analysis is evaluating what we call long-term investments. Investments can be equipment, can be investing in a new building, a new project. Any investment is something that generates more revenue. So we have to understand that we have two different things. We have two different methods. Actually, we have four methods, but they're broken into two different categories. So the first two methods will be under methods that do not use the present value. And we talked about that in chapter 11 when I talked about, chapter 12 when I talk about bonds in accounting 1A. Understanding what the present value of the dollar is. So the two different methods under that one is called the average rate of return and the cash payback method. Now, the other category are methods that use what we call present value of money, and I'll talk about that in a moment. This is called the NPV, or the net present value method, and the internal rate of return method, also known as the IRR. The two methods that use the present value understand what we talk about the time value of money concept. So what that means is a dollar that I will get in the future, what is the worth of that dollar today? So if we use present value, we're going to be looking at how much money will I generate in the future, but what is it worth today given certain criteria of interest and time. So these methods, first we're going to examine the two methods that do not use these. Now, and each method, each of the four methods as I talk to you, we're going to look at how to calculate it, and we're going to look at the advantages and the disadvantages, and we're going to talk about that. Okay? So just want you to understand the first two methods we're going to look at are methods that do not use the present value. And this is what you would use if you want to know how to decide which proposal to choose. So the first one we're going to look at is called average rate of return. It's also called the accounting rate of return. And here's my formula. So it's the average rate of return is the estimated average annual income, and we'll talk about average in a minute, divided by the average investment. Okay? So the estimated average annual income, how much do I anticipate getting from income each year on average, divided by average investment. So the average investment has its own formula. It's down here. We're going to make the assumption we're using straight line depreciation on all of these things. So the average investment is the initial cost plus the residual value divided by 2. So you've got to know this formula in order to calculate the average rate of return. So here we go. I'm thinking about buying a new piece of equipment. It's going to cost me $500. It has no residual value. It's going to estimated give me a total income each year. Total income of $200,000 over 4 years. So if I know that $200,000 is what I'm going to get over 4 years, then I know what my average annual is going to be. So let's drop this into our formula. And here we go. The first thing we're going to do is calculate the bottom number, which is the average investment. So my initial cost plus my residual divided by 2. So that ends up being $250,000. So now I plug this into my return. So the $50,000 is because it was estimated to give me $200,000 over the life of 4 years. $200,000 divided by 4 would be $50,000 each year. So if I choose this method, if I choose this proposal, it's going to give me a 20% rate of return on my money. Now, some of you would say that would be excellent. Some of you would say, well, maybe not so excellent. So this rate of return, is very important to understand. It depends on what it is, and it depends on what is the standard set forth for your actual company. So each company will actually set a minimum rate of return required by management. So if your minimum rate of return might be 10%, if that's the case, a proposal giving you a 20% is excellent. However, if your minimum rate of return is 25%, then you do not want to accept anything less than 25%. This is set up by management, and it's what if you determine what it is the minimal acceptable rate of return you are required. Now, that's it for average rate of return. So let's look at the advantages and disadvantages of it. Here are the advantages. It was very easy to figure out. There was no problem. You understood it. There's a formula. You plug it in. That's the big advantage. Let me explain the big disadvantage right here. It doesn't consider the cash flow from the proposal. It just said that you can expect $200,000 over 4 years. Now, it didn't say that it was going to be $50,000 each year, but we made that assumption in the actual calculation. So one of the biggest disadvantages that even though you're going to get a cash flow back or a net income back, the timing of that could be crucial. So average rate of return, very easy. There's a formula. Here's my advantages. Here's my disadvantages. Okay. Next, we're going to look at cash payback method. This is another method that does not care about the time value of money. And so here's my formula for cash payback. The initial cost divided by the annual net cash inflow. Net cash inflow is when you are getting money coming into your company. Now, by the name of this, you know that cash payback method, that your only concern is when will I get paid back all the money I'm investing? Okay? And so we're going to look at that formula. So I'm considering buying a new equipment. It's going to cost me $200,000. I will generate $50,000 from revenues for each year. However, expenses, including the depreciation, will be $30,000, and the depreciation is $20,000. So really, if I look at this, the actual expenses, the actual cash outlay of expenses will be $10,000 a year. So we need to talk about this depreciation. Depreciation is a non-cash expense. So here's how we're going to look at this. I expect to get $50,000 of revenue in for each year, but I can expect to pay out $10,000 cash each year for expenses because of the $30,000 total minus the depreciation. Because in reality, I'm not putting out $20,000 for depreciation. I'm only putting out $10,000. So here we are down here. I'm sorry. So I'm only really putting out $10,000. So my net cash flow per year is really only $40,000. So here's the formula. You drop in your numbers. 200,000 divided by 40,000 says, hey, in 5 years, I will get my money back. And that's what I want to know is how many years will it take for me to recoup the initial cost of the proposal? Obviously, the one with the shortest amount of years is going to be the one you want to choose. Now, we just looked at something here. The $40,000 here is all going to be every single year, according to what we've seen on the previous screen. So we need to talk about that. So when the cash flows are equal, that's how we're going to do it. However, what happens if my cash flows are not equal? That means every year it's going to be a different amount. So we have to run what we call a cumulative total. So when my cash flows are unequal, here's what I'm going to do. I'm going to start with year 1. So basically I put out $400,000 and it's got a 6-year life. So the cash flow coming in the first year is going to be $60,000. So I park that over here under cumulative. Year 2, I'm going to have $80,000. So I'm going to add that to my cumulative total 60. And at the end of year 2, I have $140,000 cumulative net cash flow. Year 3 is 105. And then year 4 brings me to 400. So my cash payback for this is 4 years. Because I'm only concerned about when will I get my $400,000 back. Okay? So obviously, payback period is 4 years with this type of investment. Remember, Depends on if your cash flow is equal or your cash flow is unequal. Now, let's talk about this. Obviously, the shorter cash payback is the one you want because the sooner you get the money back, the sooner you can turn around and reinvest it. So you always look for the one with the shortest payback. Let's talk about the advantages and disadvantages here. The advantages is it's simple to use and you understand it. I'm hoping you did. It looks at my cash flows, and that's important. How much cash will I be getting in each year? Here's the big disadvantage. It doesn't look at any monies you have coming in after the payback period. So in that previous example, when I hit 4 years, it didn't continue to count the money that would still be coming in. And you obviously, if you go back to that slide, let's go back to that slide actually. It's this one right here. So 4 years is my payback, but look, in years 5 and 6, I still have money coming in. So it doesn't look at this money here, which to me isn't good business sense. Okay, so here we are. So those are the biggest disadvantage to this is it doesn't look at the cash after the payback period, and it doesn't use the present value concept in figuring out the cash flows. And that's these two methods that we just talked about, average rate of return, cash payback method, do not use the time value of money concepts of present value. Those are going to be on my next video. So that concludes this particular video.